Hello everybody. Welcome to the second show on our official YouTube channel for SD Capital. I hope by this time you have all caught up with our first session, which was all about why this is the right time to start investing in equity market if you haven't done so already. So as I said, this second session is going to be all about myth busting. Over the years, I have asked many people, why don't you invest in equity market? I have got varied answers, but most of them indicate that they are afraid of stock market. And there are some myths what actually make them afraid of the whole thing. So I thought it's right to have a session on these myths, talk through them, and make you understand that these are really myths. There is hardly any reality in it. So enough of introduction. Let's get started. So the very first myth I have heard quite frequently is stock market is way too complex for common people like us. Only experts can manage it. Well, stock market is definitely no child's play. But just like any other thing, you need to put effort and time into it. You need to study, you need to do your own research, you need to be disciplined, and stock market will reward you in the long run. If you are unable to do that, you need to take help from someone who actually knows what he or she is doing. But believe me, if you do it yourself, you will eventually, in the long run, you will be the winner. No dispute about it. The next myth, someone is making money, so somebody must be losing money. Well, no. Let me go back to the basics. What does it mean when you buy stock of a certain company? It only means you become part owner of the company. So if the company is making profit, company is growing, you are benefiting from it. It doesn't matter if 500 people or 5,000 people or 50,000 people have invested in that same company. Everybody is winning. Everyone is winner. The third myth, this is something we actually have touched upon in our first session. Market crashes and you lose all. We have seen in the recent past two big market crashes. 2001-2 WTC, 2008-9 global financial meltdown. But as we explained with data in the first session, what goes down must come up. Both the times, within 2.5 years time, market bounced back. So if you haven't managed to exit on time, all you need to do is not to panic, stay put, stay calm, and eventually you will get back there and then market will again grow. So just be patient. If you try to sell on panic, then you lose money. The fourth myth, stock market is actually for rich people. You need a lot of money to start investing. That's not true again. There are strategies to invest in stock market, like investing in index, passive investing, even contrarian investing, where you can start with as little as 2,000 rupees, $200 or 200 pounds, depend on which country you are in. So there are ways to invest and comparatively risk-free investment as well, if you have a small pot of money. The fifth one, probably the most common one, which I hear from the people in my part of the world, it's like gambling. Okay, let's assume that you are playing with a dice. What is the chance when you toss the dice, head and tail, 50-50? If you go to a casino, what is the chance of you winning a game? If it's all fair play, everything, all ideal condition, 50-50. Now let's take a look at stock market return historically. 1926, roughly 100 years back. So from 1926 till today, if you take any 10-year period, 26 to 36 or 45 to 55 or 73 to 83, any 10-year period, you will find that 94% cases, people have made handsome profit by investing in stock. Reduce the period further, go down to 5. For any 5-year period between 1926 and today, 86% cases, people have made money by investing in stock market. And when I say made money, handsome profit. How many Vegas casinos you know where you can play and be sure that you will win? The chance of you winning is 86% or more? Probably none. So stock market has got nothing to do with gambling. It's pure science, pure numbers, pure calculations. The next myth actually is a bigger one. It's safer to invest in mutual funds and SIPs. So, what is a mutual fund actually? There is a fund manager or a team of fund manager. They pool money from investors, maybe 500, 50,000, 500,000 people, and then they invest that money in different stocks as they see fit. The problem with that is one size does not fit all. So for example, you work in oil and gas company, just like me, and then you buy stocks of a mutual fund. Basically, you invest in a mutual fund. That mutual fund invests 5% of fund value in oil and gas sector. Is it reducing your risk? If oil and gas goes down, your employment is at risk, your investment value is also at risk significantly. Let's assume another case. Someone started working for an Indian IT company at the beginning of the career, and then that person moved on. But he got some employee stock options, which is still with him. 10 years down the line, he starts investing with a mutual fund. That mutual fund have 5% of its value invested in that particular company. What happens to this person? His exposure to that one company is significantly higher. That's not fair. That doesn't how it is supposed to work. Then, the age and risk appetite factor. At the age of 25, everybody loves to take risk. No responsibility, nothing. 45, you are a family person. You have husband or wife, you have kids, you have dependent parents most likely. At the age of 60, you are bothered about your retirement. You need a steady stream of income when you retire. Now, all these three people investing in the same mutual fund, does it make sense? It doesn't. And that's the story of it. Mutual fund, again, it's not one size fits all. It doesn't work like that. Traditional SIPs, systematic investment plan. Now, let's consider somebody invest 5,000 rupees in a SIP or 100 pounds in a SIP every month. Market is at all-time high and market just got through 15% correction when value became fair. Do you want to invest the same money both the times? No, you don't. But traditional SIPs work exactly in that way. So what you need actually is a customized investment plan, customized investment strategy, which will help you best. You can do it yourself by putting time and effort, or you can take experts' help who will work considering your financial goals. Another myth, last but one myth. A little knowledge is better than none. In this particular case, it's actually not the case. A little knowledge and then you try to supplement that with your instinct, with your emotions, with your experience of the company. Say, for example, you like buying shampoo of a particular brand. You like that shampoo a lot. That doesn't mean that you start buying stocks of that company. You know that shampoo is a quite popular one. People buy it. That doesn't mean you need to buy stocks of that company. Stock market has got nothing to do with instinct or emotions or product experience. It's all about numbers once again. So you need to take a holistic view of the stock market, of the company, and then take a judgment call. You need to put effort. The last myth, intraday is safer. So some people tell you that invest in the morning, buy stocks, by the evening or rather afternoon, you exit. Or do the reverse. Basically, they are telling you that companies' stock value goes up and down in a day, typically true. and then you can make money off that. And then since you are not hanging on to it for a long time, your risk is less. That's actually the worst myth ever. Let me tell you, price actually goes up and down in a day. True, that is. But there are more sophisticated software available to the non-retail people, the investment bank people, the hedge fund people, and insurance funds people, and all of them. And also they have much faster access to the market. And you, as a retail investor, you don't have any of those. So if you try to do an intraday, 95% chance or even more that the brokerage you will pay to buy or sell a stock will nullify your profit. Then if you can make anything, then another trick is, I said, faster access. So when we see a price on our screen, that's different than when the trade is actually executed, because there is a time gap of 2 to 3 minutes. Institutional investors have special network connectivity which help them make trade in few seconds. So the price they see on the screen and the price at which the trade get executed is same. For us, it's not. And when you are talking about 1%, 2% variation, that is enough. That is enough to screw your plan. So please, 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 as retail investors, stay away from intraday. As retail investor, don't try to be speculators. Try to be investors. Have patience. Be disciplined. Study. Do your own research. And then invest in stock market. Stock market, as I said, in the long run, it is going to reward you. If you can't do that, if you don't have time to do that, then the next best option is to consult an expert and go for a customized plan. So guys and girls, for today, that is all. Take care, stay safe, stay with us. The Bengali session will come soon. And the next week, our session is going to be on a different topic again. Stay corona free. Good luck. Thanks. Bye.